Have you ever wondered why some people, despite their wealth, still struggle financially or lose money? What sets the ultra-wealthy apart from those who seem to have it all but still face financial challenges? The truth is, even the richest individuals avoid certain financial mistakes that can easily derail wealth accumulation. In this video, we'll explore the top 5 financial mistakes even rich people avoid. These are common pitfalls that even the wealthiest people take great care to avoid. Let's dive into these crucial mistakes and see how you can learn from the mistakes the rich refuse to make. 1. Neglecting taxes. One of the biggest financial mistakes that the wealthy avoid is treating taxes as an afterthought. This is a mistake most people make, especially when they're in the middle of a deal or investment. They go forward with an investment, focusing on the returns, and only later wonder about the tax implications. By then, it's often too late to make significant adjustments, and they end up paying high taxes that could have been avoided with proper planning. The wealthy, however, take a proactive approach. Before making any investment or business decision, they always coordinate with a team that includes a CPA, attorney, and financial advisor to assess the tax impact. This team approach ensures that every potential tax implication is considered before taking action. By bringing in experts who specialize in different areas, the wealthy are able to evaluate the long-term tax consequences of their decisions, ensuring they are in the best position to protect their wealth from unnecessary taxation. This strategic approach ensures that their wealth grows without being eroded by preventable tax bills. Instead of reacting to tax obligations after the fact, the wealthy plan their transactions with the tax impact in mind. For example, they may structure deals in ways that minimize capital gains or take advantage of tax credits and deductions that reduce their taxable income. The wealthy understand that by aligning their investment decisions with tax efficiency, they can maximize their returns and avoid giving away a large portion of their profits to the government. Tax strategy is not just an afterthought for the wealthy, it's a cornerstone of their financial planning. They use advanced tax-saving tools such as trusts, tax-deferred accounts, and corporate structures to keep more of their earnings working for them. By thinking ahead and planning with a coordinated team, the wealthy ensure that their wealth continues to grow without being diminished by avoidable tax consequences. This focus on tax efficiency is a key reason they are able to retain and grow their wealth, setting them apart from those who overlook the importance of tax planning. 2. False diversification. Another mistake that many wealthy individuals avoid is phantom diversification. This occurs when an investor thinks they are diversified but is actually still overly exposed to a single sector, region, or industry. For example, someone might think they're diversified by owning tech stocks, a tech-heavy index fund, and a rental property in a tech hub city like San Francisco. While on the surface, these investments seem diversified, they are still heavily reliant on the success of the tech industry. True diversification, however, means spreading your investments across different asset classes and industries so that a downturn in one sector doesn't impact the entire portfolio. The wealthy understand that real diversification requires constant monitoring and active rebalancing. If all their assets are tied to the same region or sector, a sudden downturn in that area could wipe out their wealth. By actively managing their portfolio, the wealthy ensure that their investments are spread out in such a way that no single market shock can devastate their entire financial picture. The wealthy avoid the temptation to take unnecessary risks by keeping their investments limited to one sector or region. Instead, they regularly assess their holdings and make sure their portfolio is truly diversified, with investments that can weather the storm across multiple asset types and industries. This level of foresight prevents them from falling into the trap of false diversification, which can seem safe but ultimately leads to financial vulnerability. True diversification isn't just about owning more assets, it's about owning the right mix. By maintaining exposure to multiple industries, geographies, and asset types, the wealthy ensure they don't overexpose themselves to market shifts that could jeopardize their long-term wealth. This strategic approach to diversification gives them a foundation of stability that allows them to weather market downturns without facing massive losses. 3. Tying self-worth to net worth. One financial mistake the wealthy avoid that many others fall victim to is allowing net worth to dictate self-worth. It's easy to tie your identity to your financial status, especially when you have a significant amount of wealth. The problem with this is that when you tie your emotional well-being to your net worth, You allow market fluctuations to control your mood and decision-making. The ultra-wealthy know that the stock market goes up and down, and business cycles change. If they base their self-worth on the fluctuations of their portfolio, they would constantly be in emotional turmoil. Instead, they anchor their identity in values, relationships, and personal achievements, rather than the daily movements of the market or the balance in their bank account. This detachment from wealth is key to making rational financial decisions during periods of market volatility. When the market crashes or their portfolio experiences a downturn, the wealthy avoid making impulsive, emotional decisions that could further damage their financial situation. Instead of panicking, they stay focused on their long-term goals and continue making decisions that align with their values and overall financial strategy. By not letting their self-worth be tied to their net worth, the wealthy can navigate financial ups and downs without losing sight of their true priorities. 4. Illiquidity optimism. Private equity and illiquid assets like startups and art are extremely popular with the wealthy, but these investments come with a big risk: illiquidity. The wealthy avoid the illiquidity optimism trap, which occurs when investors become overly optimistic about the exit timeline or liquidity of their illiquid assets. They might assume that they'll be able to sell their startup shares or artwork whenever they want, but the reality is that it can take years to find a buyer or realize a return on these investments. The ultra-wealthy avoid this mistake by always maintaining a margin of freedom, a liquid buffer that allows them to avoid being forced to sell their illiquid assets at a loss during times of financial stress. This buffer usually consists of cash or highly liquid investments that can cover expenses or provide liquidity when needed, without having to resort to selling long-term assets at a disadvantage. By keeping a 12-month or longer liquid buffer, the wealthy ensure they can weather financial crises without needing to sell assets prematurely, which could diminish the value of their portfolio. This strategy ensures they have freedom and flexibility, making it possible to stay invested in illiquid assets without being forced into unfavorable sales. It's a safety net that protects against the pitfalls of overly optimistic assumptions about the timing of returns on illiquid investments. 5. Gossiping about wealth. One of the fastest ways to lose money is to talk about it. Publicly gossiping about your wealth can attract unnecessary attention, lawsuits, and requests for handouts. The wealthy know this all too well and take steps to keep their financial affairs private. By avoiding the public discussion of their wealth, they protect themselves from unwanted attention and financial risks. The wealthy use a strategy called the bought status test to avoid spending or investing in ways that could attract negative attention. This test involves asking themselves if they would still buy something, like an extravagant luxury item or investment, if they couldn't tell anyone about it. The answer to this question often reveals whether the purchase is motivated by external validation rather than actual need or value. This avoidance of extrinsic validation allows the ultra-wealthy to focus on making investments and purchases that align with their personal values and financial goals. It also helps them avoid the temptation to make emotional or status-driven decisions that could jeopardize their financial stability. By keeping their wealth private, they maintain control over their financial choices and avoid the pitfalls of attracting unwanted attention. And there you have it, top 5 financial mistakes even rich people avoid. From neglecting taxes to gossiping about wealth, these are the key mistakes the wealthy actively avoid to protect and grow their fortunes. By learning from these mistakes, you can implement these strategies into your own financial life and avoid the common traps that can derail your wealth-building efforts. If you found this video helpful, make sure to like, share, and subscribe for more financial tips and strategies. Let me know in the comments which mistake you're most focused on avoiding. I'll see you in the next video.